The Federal Reserve just made a decision that's keeping millions of Americans on edge about their financial future. For the fourth meeting in a row, they've kept interest rates frozen at their current levels, but the reasons behind this choice reveal a much deeper economic uncertainty that could impact your wallet in ways you haven't considered. In this video, we'll break down why the Fed is walking such a careful tightrope right now, what's really driving their cautious approach, and what this means for your borrowing costs in the months ahead. Plus, we'll reveal the surprising divide happening inside the Federal Reserve that nobody's talking about. The Federal Reserve has maintained its benchmark interest rate at 4.25% to 4.50% for the fourth consecutive meeting. But this isn't just business as usual. Behind closed doors, Fed officials are facing unprecedented uncertainty, and their internal divisions are more pronounced than we've seen in years. Here's what's really happening. More than a third of Fed officials expect at least 2 rate cuts before the year ends, while another third believe rates should stay exactly where they are. This isn't just a minor disagreement. It's a fundamental split about the direction of the American economy. So what's causing this dramatic divide? The primary culprit is tariffs. Recent tariff policies have created a complex web of economic pressures that the Fed is still trying to understand. These tariffs are expected to drive up prices by making imports more expensive, but they also threaten to slow economic growth by reducing consumer and business spending power. Think of it like a double-edged sword. Tariffs might protect some American jobs, but they also make everyday goods more expensive for everyone. Fed officials describe the current rate level as modestly restrictive, high enough to cool down the economy without crushing it entirely. But this delicate balance is becoming harder to maintain as new economic pressures emerge. The Fed's latest economic projections paint a concerning picture. They've lowered their growth forecast for 2025 to just 1.4%, down from 1.7% in March. Meanwhile, inflation projections have been revised upward to 3%, well above their 2% target. The disagreement within the Fed has become so pronounced that some officials are breaking ranks publicly. Governor Christopher Waller argues that rate cuts could come as soon as July, believing the inflationary impact of tariffs might be temporary rather than persistent. However, Chair Jerome Powell advocates for patience, emphasizing the need to fully assess tariff impacts before making any moves. This internal tension reflects just how uncertain the economic landscape has become. The market remains skeptical about immediate rate cuts, with only a 15% probability priced in for the upcoming July meeting. This cautious stance affects everything from credit card rates to auto loans, keeping borrowing costs elevated for consumers and businesses alike. If you're planning a major purchase or considering refinancing, these elevated rates will continue impacting your decisions. Looking ahead, the Fed's approach remains firmly data-dependent. They're waiting for clearer signals about how tariffs will affect prices and economic growth before making their next move. This uncertainty means Americans should prepare for continued elevated borrowing costs in the near term, but it also suggests that when changes do come, they could be significant. The Federal Reserve's cautious stance reflects the complex economic crossroads America faces today. As they navigate between controlling inflation and supporting growth, their decisions will shape your financial landscape for months to come. If you found this breakdown helpful, subscribe for more insights into how economic policy affects your daily life.